Hello everyone, part 3 of our discussion of chapter 6. A lot of material in this chapter. This is the business use of your home. This is an important deduction because a lot of people misunderstand this deduction, and it's an important one because it can turn what is typically a personal expense into a business expense if you are operating a business out of your home. Now, the part of your home has to be used exclusively, regularly for the taxpayer's trade or business, not for rental. So, first of all, you don't get this if it's just a hobby, right? We know that. So, first of all, your business that you're operating out of your home has to be raised to the level of a business. And there has to be some way, it does not have to be a single room. It does not have to be blocked off with walls. It can be a corner of a big room, as long as there's some way to kind of designate what the part is that's used for your business. If you happen to have clients come to your home, that area where you meet with them is going to be a pretty easy sell on home office. If you don't, then you've got a situation where you've got to show that you needed a place to do all your paperwork and all of your and take phone calls or whatever that wouldn't work just regular time, and it has to be, you have no other place to do that. Okay, so you can't have an office at home for the work that you do as an employee somewhere else, typically, and make that work. It's got to be something where you have no other place to do it. But you don't have to see clients, although that's a really good indication that it is you have a home office. This goes on Form 8829. Now notice on Form 8829 as shown in your textbook, there are two columns, direct expenses and indirect expenses. Notice also the direct expenses are not filled in. You're going to put the direct expenses directly on the Schedule C. So this indirect expenses is what we're talking about, and you're looking at it by square footage. So you're going to take your square footage of your part that's used exclusively for business and divide it by the total square footage of the house. And then you multiply that percentage by the expense that you're talking about. Now, a couple of things to remember. First of all, what's included in that overall expense that you can do that for? Property taxes, interest, rent. If you pay, you're going to pay interest on owning it or renting. Repairs, utilities, insurance, all that time, homeowners insurance, all those things. Now, some of those, the part that is not business related. So you're going to multiply by the square footage. You're going to get that part that's business related. You're going to put it on the 8829. You're going to actually depreciate the part of your house the same way. 39-year property, it becomes a commercial property if you're going to use a home office. The part that's personal, that's not business related, could be an itemized deduction, because remember, interest and taxes are deductible on your Schedule A. And so you're going to take the percentage for your business on schedules on 8829 and into Schedule C, and the part that's not for business on the Schedule A, assuming you have enough to itemize your deductions. Now, there is some rules about the home office deduction. You cannot have a loss on a business. You cannot have more expenses from a home office than you have income from the business after you take other expenses. So you first always deduct any direct expenses. Then you deduct your mortgage interest and real estate taxes that you can, the percentage based on the square footage, and then you can deduct insurance, utilities, and then finally depreciation. So the point being, if you run out of income to use for your deduction, it's going to be depreciation that you're not going to get to use. Okay? So that can carry forward, but chances are you're going to have trouble with that going forward, in the sense that if your business didn't make income one year, probably you're going to have a hard time doing it in the future. So it's got to be a serious enough business to actually make enough income to use this deduction. But this can take a significant part of your house and turn it into, if you utilize it, for instance, for various aspects of your business. Now, if you have a licensed daycare, it does not have to be exclusive. You can figure it out by how many hours out of the year you utilize it. If you use it for storage of supplies or inventory, it does not have to be exclusive, meaning you could have some other things stored in there as well and not lose your deduction. Otherwise, it should be used exclusively. Now, let's see, realistically, I look at people and say, are you utilizing it for business? Most of the time. Nobody can really say, okay, well, Johnny wandered in there one time and just, played on the floor, so that shouldn't disallow the deduction. But you've got to have it such, and the IRS has been known to actually come and visit taxpayers' homes in an audit scenario to see if the home office is necessary, see what it's set up like, make sure it looks like an office and a business, and it makes sense. These things go to court fairly often in terms of what is your business, your home office. And you've got to have a business that you can make a plausible explanation as to why you need space like that. So that's just some tips about being a professional accountant and doing that for people, tax preparer, preparing their taxes. Business bad debts. I get this question all the time. If I sell something to somebody and they don't pay me, do I get to take a deduction? And the answer is usually no, because most businesses are on a cash basis, which means they didn't record any income for that sale until they were actually paid. And so not being paid is not a deduction. It's only a deduction if you're on an accrual basis, or if you happen to loan somebody money, which is much more rare than selling them something on credit. Okay, but it can't, if you had a loan, it's partially worthless or completely worthless, you're not going to collect it. You have a deduction for that, an ordinary loss, and then casualty losses. Not limited like personal casualty, if fire, flood, that sort of thing, theft, but it can't be reimbursed, meaning if the insurance pays you for it, you don't get a deduction, or you only get a deduction or loss for the difference between what it was worth and what the insurance paid you. Okay? So returning back to the hobby loss, gone basically. Expenses not allowed, income must be included, as we discussed earlier. And then our last topic here, before we get to self-employment, the tax calculation, education expenses. Sometimes comes up, pay for going to classes and things. If it improves your skills or meets your requirements for the law, for instance, as a CPA, I have to get my continuing education. All of that cost is deductible. However, if it is the minimum education requirement for employment, then not. All right. Now, this doesn't usually come up with if you are in business with yourself as Schedule C, because you wouldn't already be in business, okay? Because you didn't meet the minimum educational requirements. Or qualify as a taxpayer for a new trade or business. Not if you're expanding your business, that's fine, but if it's a brand new trade or business, technically it's not deductible. There's a couple of questions in your, one in your homework a little bit to kind of a judgment call, and typically you can make a pretty good case that you need to improve your skills, even if it's a little bit outside of your norm. But if you're getting an entirely new type of business, if you're a doctor and you go to school to become go back, take classes to be a stockbroker, that's going to be not going to work. So you'll have to use some of the other deductions, the deduction for tuition that we talked about back in chapter 5 or 4, I believe, or one of the education credits we'll discuss later. Yeah, calculate self-employment tax. This often comes as a big surprise to people who are self-employed. You have to pay. If you're an employee, you pay your Social Security tax. It's taken out of your check, and your employer is paying the other half. They're matching that. When you are self-employed, you're both the employee and the employer, so you're paying both sides. So you're paying 15.3% on first $132,900 of self-employment income. Now you take your income off the Schedule C, you multiply it by 0.9235, okay, and then you multiply it by the percentage there. The Medicare goes up, and in fact there's an additional Medicare tax on higher incomes over $250,000, but the Social Security you only calculate in the first $132,900. If you're both employed and self-employed, meaning you have salary, then you count that towards your max, the limit. So if you had salary of $60,000 for a year, then you would have self-employment income up to the other $72,900 until you got to the limit, okay? But you wouldn't have to do it on a whole $132,900. And then in 2017, the new tax law created a new deduction for 2018, 2019, and going forward. That is a QBI deduction, qualified business income. Now, thing to remember about this does not get reported on the Schedule C. It's based on your income on the Schedule C, but it actually is a deduction directly on the 1040 or yes, directly on the 1040, but actually line 10. It has its own place. It's not on the Schedule C, but it's based on that. It's 20% of your income on the Schedule C, or your taxable income, whichever is less. It starts to go away if your income is over those threshold. Depending on the type of business, okay, and whether you're paying out in employees, and it's limited to how much you pay out as W-2 income to your employees. So the thing to remember is that most of the reductions or the phase out don't kick in till in this, or the restrictions on this, until you get to those thresholds, 315 or 157.5. So for most businesses, as long as it qualifies as a business, they get to take this deduction until they get to their income is over those thresholds, and then you have to look at which restrictions apply in this type of scenario.